Thank you, Chris, and well done with pronouncing my name there. You did well. Thank you. Thanks. Let me just get this screen sharing thing going. There you go. As you can see, I am trying to hack the system a little bit here. So I'm showing my face there in the right and bottom corner. I hope it's working. And yeah, because I think that should be a feature of this platform. But in any case, it's not. So let's just do it this way. Okay, guys. So my name is Carel de Jager. I am, like Chris said, at the Blockchain Academy, and the aim of this talk is going to be educational. I'm going to try and give us a platform in a very short space of time. I only have 15 minutes. To give you a little bit of background of what is DeFi. If you were a little bit lost during the first half of this conference, then you are at the right stage now, because I'm going to try and squeeze as much information as I possibly can within 15 minutes. I wanted to give away some collateralized contracts, but unfortunately the gas price on ETH is so high now that I won't be able to do that. So apologies for that. I think some people expected it because I usually do that during my talks. All right, let me just see what I'll say. There it goes. Okay, so to start off, in 2009, Satoshi Nakamoto landed the cornerstone of what would have become a complete transformation of finance as we know it. Before then, a global economy didn't really exist. You know, the financial system is made up of fortresses and functioned only within imaginary borders. It was only accessible to a select few people, and its main purpose was actually to serve as a mechanism for rulers to protect their self-esteem. Sorry, but I have to say that. And for the first few years of Bitcoin's existence, it threatened mostly the remittances and retail functions of traditional banking. But now with the birth of DeFi, this has actually changed. And I cannot think of one function of banking that we cannot now replace with smart contracts and completely reinvent. So let me tell you then what is DeFi. So DeFi is basically the use of smart contracts to program complex financial instruments. Functions such as lending, borrowing, decentralized exchanges, and complex financial trading instruments. And these things all require trust in order to function as intended. You can just imagine, if you trade derivatives, your margin for error becomes exponentially smaller compared to normal trading. Traditionally, the speed of settlement and level of accuracy required to enable these functions was achieved by trusted middlemen or clearinghouses who would have the ultimate authority to resolve any disputes that traders might have between each other, that two traders might have on different sides of a transaction. In DeFi, no one has that kind of authority. At least they're not supposed to have. So the protocol or the smart contract code is the only law that applies in this case. And this really redefines our ideas of banking. I mean, if we don't need a bank for settlement anymore, then you have to ask yourself the question, why do we need banking at all? So in order to understand DeFi, you have to understand the concept of a stablecoin first. It's quite important. I think stablecoins are integral in the middle of most DeFi protocols and most DeFi applications. So a stablecoin is basically a subjective. It's a decentralized currency that is pegged to some stable source of value. And the reason we need that is because we know that cryptocurrencies have some weird experimental monetary policies. Most of them are very radical, very deflationary. Some of them are very inflationary. So it's a little bit weird, and that prevents them from being stable. Of course, that's not the only thing that prevents them from being stable, but it does play a big role. And that's why we need some source of stability. And we've had stablecoins for some time now, but they've been highly centralized, and they've had single points of failure. And applications such as consumer loans, prediction markets, decentralized insurance, all of these things need stability to work. Even remittances suffer when you have too much volatility. Now, a stable coin or cryptocurrency, as I said, is linked to some sort of stability, and that stability, that source of stability, is also subjective. So let's say for a moment, let's imagine that the US dollar is stable. How do you peg a decentralized currency to the dollar, to this dollar? Well, there's basically three ways. Either non-collateralized, so which means that the value is controlled by algorithmically controlling the supply. We know that the price of anything is basically the ratio of supply and demand. And since we cannot control demand, a smart contract simply adjusts the supply to keep the coin at, let's say, $1. It's not so easy to control the supply though, because your smart contract needs an efficient entry and exit point to the market. And it needs lots of liquidity in order to effectively control the supply. And that is not so simple. So the second way is to collateralize with fiat. Now this works quite well. It's quite simple. You take some dollars, you put it in a bank and you mint coins. The problem is that bank accounts are only available to humans and they can be shut down. So you centralize the process, you create a single point of failure, and you effectively place a lot of trust in whoever has access to that bank account. We know that USD Tether is a good example of a fiat collateralized stablecoin, and it's been working relatively well so far. But there are lots of issues. Like, for instance, we cannot guarantee that the dollars will be there tomorrow, which collateral. We cannot even guarantee that they are there today. All right, so the answer is crypto collateralized stablecoins. And this is simple. It's a smart contract that holds a certain amount of crypto assets, and it mints a stablecoin in return. A stability fee is charged to anyone providing the liquidity and adjusted in such a way as to incentivize holders of this stablecoin to either mint more of this stablecoin or to burn the ones that they have. And this keeps the price relatively stable. It is 100% decentralized. At least it could be 100% decentralized, and it works well. So if you are new in this space, then the one stablecoin that you should keep an eye on is DAI. That's issued by the Maker protocol. When in your quest in learning what DeFi is all about, you will encounter DAI quite a lot, quite frequently. So I want to touch on two applications within the DeFi space, or in the DeFi realm. And that is the first one is lending and borrowing, and then the second one is decentralized exchanges. Of course, it extends further than that. But when you start learning about DeFi, then these two are the two applications that you'll probably use first. So in terms of lending and borrowing, imagine you need to obtain credit. We know that when you need to borrow money or you need to get credit, you either need collateral or you need a reputation. Now, a reputation is basically your credit score. It's a subjective measure of whether you can repay that loan or not. And there's numerous issues with that. I mean, your landlord can literally mess up your credit score if you decide to paint your wall. That's quite ridiculous if you think about it that way. So the other way to get a loan is to have collateral. Now, when you buy a house, then that house is used as security and you get a loan. Same with vehicles or any other asset. And there's many legacy issues with that as well. I mean, you are by law limited to the amount of credits that you can get. And collateral such as property is very illiquid. So it poses quite a lot of risks to the credit provider. If you default, then it's quite difficult to get that cash back. If, for instance, you have a property as security. So how do we do it with DeFi then? Well, reputation is quite difficult. Blockchains are trustless environments and very adversarial. Anything can go wrong, and anything that can go wrong will go wrong, and it's a hacker's paradise. So we can't really have reputational services. Not yet. We can't effectively get reputation on top of a DeFi, also because you don't really have an identity when you interact with these systems. So we need to go with the option of collateral. Luckily, blockchains are extremely good at protecting digital assets. So we can lock up these assets in smart contracts. We know that they have value, and we can produce liquidity from it. So most DeFi protocols actually works that way. So this does not mean that we will never have uncollateralized loans. In fact, since we are programming these functions into smart contracts, it opens the door for us to do incredible things that would have never been possible in traditional banking. Like, something that really fascinates me is flash loans. I think it's one of the most interesting applications in DeFi. It means that you can take a loan, basically of any size, unlimited, and without any collateral, you can borrow that money, provided that you pay it back atomically. which means that you need to do it within the same operation. So in the few seconds of you taking the loan and repaying that loan again, you can do with that money whatever you want. You can arbitrage, you can liquidate the CBD contract, whatever, and you get to keep the profit. So that is quite amazing. And the reason why that is amazing to me is it's basically an extension, an extrapolation of what is possible in the traditional banking world. All of the other DeFi applications, you kind of can imagine how you could do it. It's much more difficult and all that, I understand, but you kind of imagine how you could do it in traditional banking. But flash loans is just incredible. And I think we would see more and more of these things that we cannot even imagine that is possible with DeFi, that's never been possible in the past. So one of the things that I asked myself is, when I first encountered this, when I opened the Maker CDB contract, it was last year. It was my first interaction with DeFi. One of the questions I asked myself was, why did I just sell my Ether and use the cash to do whatever I need to do? And that question bothered me for quite a while, and I had to think about it for a while, and I came up with quite a lot of reasons. So imagine you want to buy a house and you want to take out a loan through a bank to buy a house. You know that it's a lot of paperwork. It's basically impossible. It's very difficult to get that loan, and you have to kind of answer the same questions over and over again. And if you wonder about it and want to know more about the difference between getting a loan through a bank versus taking out a DeFi loan, I encourage you to watch a video by Richard D'Souza, who's also speaking today, but he also spoke earlier this year at Blockchain Africa conference, in which he described that process. It's a very good video. So, but in short, the reason is as follows. So, first of all, it's leverage. So, you can leverage your assets by taking a loan against it. So basically, what you do is you lock up your ETH, you get DAI out on the other side. Remember, DAI is a stablecoin. You buy Ether again, you lock it up again, you get DAI again, and you rinse and repeat this process until you can't anymore. And this way, you're taking out a leveraged long position on the price of ETH. So it's a high risk, but it's also a high return if the price appreciates. So that's the first thing you can do with a DeFi loan that you can't do with a conventional loan. Then the second thing is you keep access to your assets. You keep exposure to your assets. So perhaps you need liquidity for some reason, and you don't want to lose access to your hard-earned or hard-mined Ether. Maybe you have some sentimental value to it. Or maybe you have some anonymous Ether or some tainted Ether, and therefore you cannot sell it, or whatever the reason may be. You want to keep access to your Ether, but you want to unlock your liquidity, then that is another reason. The third reason is perhaps you do not qualify for a conventional loan. You have some kind of KYC or AML conflict, or your reputation is bad. Perhaps you are blacklisted, or you simply have too much exposure already and you cannot get a loan. Then that is another reason why you would rather take out a DeFi loan and collateralize your Ether or your digital assets. And then the next reason is the one that really convinced me. So I need you to think about this for a while. So put your thinking cap on now. If you take a DeFi loan out, you must keep in mind that you never have to repay it. No one will come knock on your door and ask you for your DAI when you take out a loan. So let's compare this to selling your ETH then on the open market instead of borrowing DAI. Imagine the price of ETH falls substantially shortly after you sold it. Well, then you are lucky and you are better off with your fiat money. But let's say the price rises sharply after you sold it. Well, then you missed out on all the gains because you exited your trading position. By taking out a DeFi loan, you are covered on both sides of this price movement. So what I mean by that is, if the price of ETH crashes, well, then your contract will simply be liquidated and you get to keep the cash. You don't have to go and repay that loan then. You get to keep the DAI. So you are protected on the downside. Same as if you would have sold your ETH. If the price goes to the moon, well, then you can simply go and pay back the original loan that you took out and get some cheap ETH in return. You get the the ETH at the same price as at which you locked it up originally. So you are basically covered in both directions. The second last reason is tax management. Remember that if you sell an asset, it triggers a taxable event and you'll be liable for capital gains tax. But if you lock up that asset and take out a loan, it is by definition not taxable anymore. All right? I'm not sure if the regulator will understand it if you mention DeFi, but you know, it's as true to the definition of a collateralized loan as anything else that we have in traditional banking. And then the last one is it makes you self-sovereign. You are ascending the ladder of self-sovereignty. Thanks, Andreas. So, how much time do I have left? I don't actually know. All right, I think I have 5 minutes left. So basically, I won't be able to finish, but let me just quickly show you this this last couple slides. So this is we know that the Ethereum ecosystem is growing at an immense pace. This is just a snapshot of, but this is not even everything. I mean, I found quite a lot of DeFi protocols and DeFi applications that's even not on this list. So if you are interested in learning more about it, well, then I'm quickly going to give you a 5-step program. First, you need to obtain ETH, of course. You need to go to some sort of a exchange, some traditional exchange. You get ETH, you take that ETH, you download a wallet. I can recommend MetaMask. MetaMask is a browser add-on, so it's very easy to use. You send that ETH from the exchange to the MetaMask wallet. Then you head over to this thing that's behind my video. Then you head over to Oasis.app. It's not called CDPs anymore. You head over to Oasis.app. It's an implementation of the Maker platform. You lock up your ETH with your MetaMask wallet, and on the other side you get DAI, and then you can use that DAI, and you can either go sell it and if you want to, or buy something with it. But if you want to explore further, then you go to Compound. Perhaps you have some ERC20 tokens lying around. Maybe you speculated recently and you want to use those tokens and earn interest on them. Then you can do that through Compound, or you can lock them up as collateral and borrow something else. So I encourage you to then do that. And then lastly, you go over to Uniswap and you take some of your assets and you swap them around for others. Uniswap is a decentralized exchange. It's quite phenomenal. Now, all of these things have very, very clean user interfaces. It's very easy to experience. And I encourage you to go and give it a try. Don't refinance your house, but take a few dollars and give these things a try and learn from that experience. And one thing that you need to keep in mind when you do all of these things is the trust model. Think about how difficult it was for you to onboard to this decentralized finance world, and compare that to the trust that is required when you engage in traditional banking systems. All right, the last thing that I want to mention is the order book. It's a little bit technical, but it is something that you will see in decentralized exchanges. If you compare that to a normal exchange, you will realize that there's no order book. With a normal exchange, you have there on the left, you'll see you have a normal order book, and it requires a lot of trust in order to execute a trade, because there needs to be some sort of trust in settlement, and that needs to happen instantly. You can't have any delays. Of course, we know that with normal blockchain systems, Netstate, for instance, Ethereum, the block times are about, I think, 15 seconds. So you can't have instant settlement, and that was a real problem with decentralized exchanges, and it took away quite a lot of the user experience. For those of you who've dealt with Ether Delta back in the day, you'll know what I mean. So that problem was solved through the use of automated market makers, which is basically when you use Uniswap, you will realize that there are no order book. You do not make an offer on a token. You simply swap it for another token, and the price that you will pay is basically the ratio of liquidity within that smart contract between the two tokens. If you swap so much that you actually move the price, then an arbitrage opportunity opens up. There's a gap between the real market value and that of the smart contract. and then other role players that might make use of flash loans or whatever can step in and correct the situation and profit from that and bring the price back to its real market value. So yeah, basically guys, that's it. Short overview. Feel free to engage with the Blockchain Academy and myself on social media, and we can continue this discussion. I think I'll also hang around in some of these booths and meeting places, these virtual meeting places. And yeah, thanks for tuning in. I really appreciate it.
Hey, Carl.
Yeah. Hi, Theo.
Yeah, thank you so much for that, mate. How are you?
Great, and you?
So we've got two questions here. One is, will all smart contracts on DeFi enable smart contracts that protect certain intellectual property smart contract service provider? From JC Wood.
Okay, so JC, yes. So it is possible. I mean, you can tweak the smart contracts in many ways, but in essence, every smart contract on Ethereum is open source and completely transparent for anyone to audit. Now, of course, some people bend those rules and they give themselves root access and administrator access, and they purposefully make these things more centralized. But the beauty of this is that you can decide yourself whether you want to interact with such a smart contract or not. The risks, at least, are completely clear to everyone.
Question.
Yeah.
I think we are out of time,
Cool.
but you will be hanging around. I know you'll be in the booth as well. So if there's anybody that's got any questions for Carl, super knowledgeable, and as well, he's the main facilitator for Blockchain Academy as well. So he goes around and does his courses as well. So thank you for that, Carl, and we're moving on to the next session.
Thank you so much, Theo. Guys, enjoy the conference. Cheers.